Oil and gas companies have dominated the list of the TSX best performers so far this year. How are companies using these higher energy prices, although they are down from their peaks, to harvest cash, and what are they doing with it? Here is a CEO who has been making decisions along those lines. We're joined by Ian Dundas. He heads up Enerplus. Ian, great to talk to you once again.
Andrew, how are you?
Very good. Give us an idea of what business is like for you right now. And just remind us, are you most exposed to WTI or natural gas? What are the most important commodities for you?
So we're focused, most of our business is focused in North Dakota in an oil play called Bakken. When you look at our company, call it 2/3 of our revenue comes from oil and about 1/3 from natural gas. How are conditions? On one level, they're as strong as they've ever been for companies like ours. You've got high prices. But we are dealing with inflationary issues, and we're thinking about recessions and those sorts of things. But if you stand back, the picture looks pretty resilient for our business.
You were early in the Marcellus, the U.S. natural gas play. Are you still big there?
Yeah, it's a smaller part of our business. It would only attract about just over 10% of our spending.
Okay.
But with gas prices being as high as they are right now, it's pretty meaningful relative to our cash flows. I'll just give you a feel for it. I mean, the Marcellus alone, we will free cash flow this year after our spending about $250 million US. That's the biggest number we've ever seen down there.
Tell us what you're doing buybacks and dividends. You increased the dividend lately. So how much cash do you hope to return to shareholders over the next year?
Our strategy, in fact, it's been actually quite consistent over the last 5 or 6 years. We like to grow the business. We like to do it in a sustainable way. And we like to look for opportunities to return capital back to our shareholders. And we've done that consistently. This year, we're going to grow our business. We're going to generate a lot of free cash flow. We're going to pay down some debt with that. And then you highlighted the returns to shareholders. That's obviously a pretty important part of the business. This year we'll return about $425 million to investors through a combination of dividends and share buybacks. If you look at it year to date, we really have been leaning into the share buyback. We see a lot of value in the stock, and we just finished buying back about 10% of our stock over the last year. And our goal is to continue to do that.
Right. So you said how much cash you said more than $400 million to shareholders this year, I think?
Yeah, the numbers are extraordinary, Andrew. We haven't seen them. I've been in the company for 20 years. We've never seen numbers like this. But this year, $425 million US is sort of what we said is a guaranteed number that we're going to return to shareholders. Year to date, we've returned just over $200 million, and so we see another 200 plus over the back half of the year. Right.
So 400 million US plus, and your market cap is less than 4 billion US. So that's a cash return rate of more than 10%.
Yeah, the cash yields that people talk about, I mean, you have to sort of pause and reflect on what they mean.
Yeah.
Our free cash flow yield, will generate after investment over 20% free cash flow yield. The business will grow. We'll pay down debt, and then again, we're going to return a fair amount of that to shareholders too.
So tell us you must be a little frustrated though, because you're giving all the money back to shareholders. What about if you come across a big acquisition opportunity or some property that's just screaming out? Would you not like to allocate cash there instead of just returning it all?
Yeah, I'm not at all frustrated. That is not my mindset.
Okay.
At least not relative to shareholders. No, I mean our business, in the last 5 or 6 years, we've tried to maintain balance, and then we looked for opportunities that made sense where we could make money for people. So we bought almost $1 billion of assets in the middle of the pandemic. That completely changed our business, created a significant inventory. We see more than a decade of undrilled drilling opportunities in front of us. So that's created the opportunity for where we are now, where we don't need to invest all of our cash flow. We can still grow the business and return and pay down debt. So, I'd say, Andrew, it's a bit of an all of the above strategy. If we saw something out there that we thought would make our business better, where we can make money for people, we've got the financial capacity to do that.
Now, you just divested a big chunk of your Canadian production. Remind us what you sold and why did you decide to do that?
Yeah, so just to frame it for you, think our business produces over 100,000 barrels of oil equivalent a day after royalties. Canada's less than 5% of that. So, over the years, as you said in your opening, we've been increasingly focusing our business on U.S. operations. The history of the company had been Canadian operations. Today, the future looks like U.S. operations. And so we've been divesting the Canadian assets over time. So it's been quite modest. The last bit we have in Canada is just over 5,000 BOE a day. Half of that we've entered into an agreement to sell, and we're looking to deal with the rest.
Oh, only 5,000, because your production is something like 100,000 barrels of oil equivalent a day.
Yeah, like you've got to go back a decade plus when the Canadian assets were really material. And so we've just looked for opportunities to harvest value for them. They've been well managed, but they're just not material for our company any longer.
Why is that? Is it because, why have you pulled back from Canada? Is it because you feel the environment is less attractive?
No, that wasn't really the driver. In fact, we entered the U.S., I'm going to date myself here, about 20 years ago. And it was almost the opposite dynamic, where the Canadian industry was so heated. There was so much interest in it. We found ourselves in a position where it was hard to make money. So we went into the U.S. And we're at the absolute beginning of the shale revolution. And so over time, one of the big parts of our strategy involved focusing on quality things. And we had a real interesting opportunity in the U.S. and we just continued to focus on it. So it hasn't been sort of the political uncertainty and the complicated energy policy in Canada. That wasn't the thing that drove us away. It's just, that's where we are right now in the U.S. and that's the focus of our business.